Hello everyone, welcome back to Accountant's Desk. In this video, we will learn accounting step by step from the very beginning concepts, rules of accounting, journal entries, ledgers, trial balance, and finally the preparation of final accounts. Whether you are a student or a beginner who want to learn accounting step by step, this video will guide you through everything in a clear and simple way. Before we begin, don't forget to like this video, share it with your friends, and subscribe to the channel for more accounting lessons. So let's get started with accounting basics. Let's say you start a small business, maybe a grocery store. You buy stock, pay rent, sell products, and have daily expenses. If you don't track your income and expenses, you won't know how much profit you made. Are you running at a loss? Where is your money going? That's where accounting comes in. It is the language of business. What is accounting? Accounting is the process of recording, classifying, summarizing, and interpreting financial transactions. Let's say you bought goods for rupees 10,000. You write it down into accounting records, that is journal. Then you classify by grouping similar transactions together into one account, like all the purchases into purchase account, all rent payments into rent account. Then you summarize by calculating the total to see the overall picture of the business. At the end of the month, you check the total sales, total expenses, total profit. Then you interpret by understanding what the numbers say about your business. After seeing your accounts, you realize your expenses are more than the income. That means you are incurring a loss and you need to control the costs. In simple words, accounting helps us to keep track of money, where it is coming from and where it goes. Objectives of accounting: to record all financial transactions systematically so that nothing is missed and everything is organized. To know the financial position of the business by preparing balance sheet which shows what the business owes and owns. To find out the profit or loss by preparing trading and profit and loss account. To provide financial information for decision making such as owners, managers, investors, and others who are involved in decision making. Importance of accounting: it helps in decision making, creates financial statements and budget projections, improves cash flow and supports investing decisions, ensures compliance with taxes and statutory laws, maintains accurate records using accounting systems. Who are the users of accounting information? Business owners, investors and lenders, government and tax authorities, employees, creditors and suppliers. Accounting information helps all of them to make the right decision. Basic terms in accounting: assets, what the business owns, such as cash, stock, furniture; liabilities, what the business owes to outsiders, such as loans, creditors; capital, it is the money invested by the owner; income, it is the money earned by the sale of goods and services; expenses, it is the money spent to run the business. We are going to learn the most important basic accounting concepts, the principles behind why we do what we do in accounting. These concepts are essential to understand before we move on to the journal entries, ledger, or final accounts. So stay with me till the end. I will give you simple examples for each concept. Business entity concept. According to this concept, the business is treated as separate from the owner. This means that owner and the business are treated as separate. When the business owner invests capital into the business, it is treated as a liability for the business. Money measurement concept. The money measurement concept says only transactions that can be measured in terms of money are recorded in the books. This means that only money or money's worth are recorded into the business. If you have a team of amazing employees, that is great, but unless you pay salaries or bonuses, it won't appear in the accounting records. Going concern concept. The going concern concept assumes that the business will continue operating in the foreseeable future. According to this concept, Every decision in the company is taken with the objective in mind of running the business, not liquidating it. Let's say the business buys an asset and the life of the asset is for 3 years. So instead of depreciating the whole amount in 1 year, we depreciate for 3 years according to the life of the asset. So according to going concern concept, we assume that the business will continue operating long enough to use the asset fully. The business isn't shutting down anytime soon. Cost concept. According to cost concept, assets are recorded at their original cost, not at current market value. It means that we record the cost of the asset at the price we have purchased, not according to their current value. For example, we buy a building for rupees 10 lakh, and in future if the cost increases to 15 lakhs, even though we record the cost of the building as 10 lakh in our books because it is the cost that we have purchased the building. Dual aspect concept. The dual aspect concept says every transaction has two sides, a debit and a credit. That is, assets is equals to liabilities plus capital. This is the base of the double entry system. Every equation must stay balanced after every transaction. For example, we have purchased goods for cash rupees 10,000. Then the transaction will be purchase account debit rupees 10,000 to cash account rupees 10,000. Now we can see that debit and credit both are equal. Revenue realization concept. According to revenue realization concept, income is recorded when it is earned, not when money is received. Let's say we sold goods for rupees 10,000 in the month of March, but we have received payment in the month of April. Still, we will record the sales in the month of March because we made sales during the month of March. So, according to revenue realization, when we sell the goods, we record the income, not when we receive the cash. Matching concept. According to the matching concept, expenses must be recorded in the same period as the income they help to earn. Let's say we have electricity expenses of rupees 3,000 in the month of March for producing goods that we sell in the month of March. Both should be recorded in the same month. That is, expenses of the electricity bill and then sales during the month of March should be recorded in the same period. Consistency concept. The business should use the same accounting method each year for comparison and accuracy. If you change the accounting method, you must explain the reason. According to this concept, the business must follow the same accounting principles, such as for depreciation. There are different methods in depreciation. We can't use the straight line method in 1 year and reducing balance method in next year. It does not help us to compare our accounting system. So we need to follow the same accounting principles every year. Conservatism concept. This concept says anticipate losses, not profits. The business will record future losses but won't record income until it's actually earned. Let's say the debtor may not pay us money, so we create the provision for doubtful debts. But if we have an expected profit from the deal in the next month, we will not record it now, so that the business needs to be prepared for the future. Accounting period concept. The accounting period concept means that a business's life is divided into fixed time periods, usually one financial year, to measure its performance. This means that even though the business will continue to operate, we prepare profit and loss account, balance sheet for 1 year to know the position of the business, if the business is making profit or loss. Full disclosure concept. According to the full disclosure concept, all important financial information must be clearly disclosed in the final accounts. The financial information helps stakeholders like investors, creditors, government to make the informed decisions. So we need to disclose all the financial information. If there is a lawsuit against the business or if loan is taken, it should be disclosed in the notes even if it doesn't appear directly on the balance sheet. Materiality concept. The materiality concept says that we should record and disclose only those items that are important enough to influence business decisions. This means that the business should record all the important information that is required, but small items can be just adjusted. Materiality means we focus only on the important transactions. Small things that don't affect the business's big picture can be simplified. Example, if the business buys a calculator for rupees 500, it can be treated as an expense instead of an asset because it is not material to the financial statement. Objectivity concept. The objectivity concept means that all accounting entries should be based on verifiable evidence like invoices, bills, contracts, or receipts, not personal opinion. This means that all the accounting transactions should have an evidence like bills. It should not be just guesswork or an opinion. The golden rules of accounting, the foundation of all accounting entries. There are three types of accounts: personal account related to people and organizations, real account related to assets and properties, nominal account related to expenses, incomes, losses, and gains. Golden rules of accounting. Types of account: personal account. The rule for personal account is debit the receiver and credit the giver. For real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. Now let's see the example. Started business with cash, rupees 1 lakh. Cash, it is real account, debit what comes in. And next account is capital account. It is personal account and credit owner is the giver. So the journal entry is cash account, debit 1 lakh rupees to capital account 1 lakh rupees. And narration is being started business with cash. Next example, purchased furniture for 10,000 rupees in cash. Furniture account, it's real account, so debit what comes in. Cash account, a real account, credit what goes out. So the journal entry is furniture account, debit rupees 10,000 to cash account rupees 10,000. Narration is being purchased furniture for cash. Next example, paid office rent rupees 10,000. So rent account, it is nominal account and it is an expense, so debit all expenses. The other account is cash account. It is real account, so cash goes out of the business, so credit what goes out. And the journal entry is rent account debit rupees 10,000 to cash account rupees 10,000. And the narration is being paid office rent. Let's understand the modern rules of accounting using the acronym DEALER. Modern rules of accounting: D for dividend, debit increase, credit decrease. E for expenses, debit increase, credit decrease. A for assets, debit increase, credit decrease. L for liabilities, debit decrease, credit increase. E for equity, debit decrease, credit increase. R for revenue, debit decrease, credit increase. The normal balance for each account, like dividend, expense, and assets, is debit, and liabilities, equity, and revenue, the normal balance is credit. These are very helpful when recording transactions in modern way. Now let's look at some of the examples. Sold goods for cash rupees 12,000. Cash is an asset and it increases, so it is debit. Sales is revenue and sales increases, so it is credit. Journal entries: cash account debit rupees 12,000, To sales account rupees 12,000. Narration is being sold goods for cash. Received commission rupees 1,000. Cash is an asset and cash increases so it is debit. Commission is an income and it increases so it is credit. And the journal entry is cash account debit rupees 1,000 to commission account rupees 1,000. Narration is being received commission. Paid salary rupees 3,000. Salary is an expenses and it increases so it is debit. Cash is an asset and it decreases so it is credit. Journal entries salary account debit 3,000 to cash account rupees 3,000. Narration being paid salary. Withdrew cash for personal use rupees 1,000. Drawings it is capital and capital decreases when there is a drawings by the owner so it is debit. Cash is an asset and it decreases so it is credit. Journal entry drawings account debit rupees 1,000 to cash account rupees 1,000. Being withdrew cash for personal use. Deposited rupees 5,000 into bank. Bank is an asset and cash in bank increases so it is debit. Cash is an asset and cash in hand decreases so it is credit. And the journal entries bank account debit rupees 5,000 to cash account rupees 5,000. And the narration is being deposited cash into bank. Paid electricity bill rupees 800. Electricity expenses it increases so it is debit. Cash is an asset and it decreases so it is credit. And the journal entries electricity expenses account debit rupees 800 to cash account rupees 800. Narration is being paid electricity bill. We will understand how to apply debit and credit using practical journal entries. Rules of debit and credit. Before we jump into examples, it is important to understand how different types of accounts behave. Every account in accounting fits into one of the six categories: assets, liabilities, equity and capital, expenses and losses, revenue and gains, and drawings. Now the logic is simple. Expenses and assets increases on the debit balance and decreases on the credit balance. On the other hand, liabilities, equity and capital, and revenue and gains decreases on the debit balance and increases on the credit balance. Drawings, which is what the owners take out from the business, and it is similar to the expenses. So, it increases on the debit balance and decreases on the credit balance. Once you understand this behavior, you will know exactly which side to record each transaction, debit or credit. Now let's understand with the help of examples. Mr. A started business with cash rupees 5 lakh. Now let's break this down. Not just the format but why we debit one account and credit another account. That's what really matters in accounting. Here, the business receives cash, which is an asset. So it increases and we debit it. And capital also increases, but it's a liability from the business point of view. So it is credited. So here, cash account and capital account. And we record it as cash account, capital account. Cash is an asset. And if an asset increases, it is on the debit side. So 5 lakh rupees on the debit side and capital increases, but it is liability for the business. So it is credited. So 5 lakh rupees on the credit side. Now let's see another example. Opened a bank account with rupees 3 lakh. Cash is going into the bank. Since the bank is receiving, we debit it. Cash is going out, so we credit it. Always follow the flow. So it is bank account. Bank is a personal account. Debit the receiver. And cash is real account. So credit what goes out. So we record it as bank account and cash account. Bank account debit side 3 lakh rupees and cash account credit side rupees 3 lakh. Next, bought furniture and issued check rupees 50,000. Furniture is an asset and it is coming in, so we debit it. The payment is through bank, which decreases, so we credit it. Furniture account, it is real, debit what comes in. And credit bank account. Bank is a personal account and credit is the giver. So the accounts are furniture account, bank account. Debit side for the furniture 50,000 and credit side for the bank 50,000. Next, purchase goods for rupees 60,000. Purchases are considered as expense. That is why we debit it and cash is going out. So we credit what goes out. So purchase account to cash account and we record it as purchase account and cash account. Purchase account debit side 60,000 and cash account credit side rupees 60,000. Next, sold goods costing rupees 15,000 for rupees 25,000 to Mr. B. Sales is an income. That's why we credit it. And customer Mr. B will pay us, so we debit him. So Mr. B, his personal, debit the receiver. To sales, it is nominal account, so credit all incomes and gains. And we record it as Mr. B account and sales account. Debit side Mr. B 25,000 and credit side sales 25,000. Next, sold goods for rupees 15,000. Whether you are selling for cash or credit, the rule stays the same. Revenue always increases, so it is credited. And here, instead of debtor, we take it as cash. So it is cash account debit to sales account. And we record it as cash account, sales account. Cash account debit side 15,000 and sales account credit side 15,000. Now you may ask, in the last transaction we have taken Mr. B and in this transaction why cash? The reason is the last transaction it was given as Mr. B, means it was credit transaction. And in this transaction there is nothing, no name is mentioned. So we take it as cash transaction. Cash versus accrual accounting. What is cash basis accounting? According to cash basis accounting, revenue is recorded when cash is received and expenses are recorded when cash is paid. It is easy to track cash flow. That means if no money is exchanged, no entry is recorded. This method is easy to use and helps small businesses to track how much cash they really have at any point in time. It's like checking your wallet. You know exactly what's there and what's gone. Example of cash basis. Let's understand this with a quick example. Suppose you did freelance work in May, but your client paid you rupees 10,000 on June 5th. In cash basis accounting, you will record this income in June, not May. Why? Because that's when you actually received the money. This keeps your records very simple and cash focused. What is accrual basis accounting? Now let's look at the accrual basis, which is more advanced but also more accurate. In accrual accounting, revenue is recorded when earned, not when received, and expenses are recorded when incurred, not when paid. It shows true financial health. It helps businesses match income with the expenses related to earn that income, even if the payment hasn't paid yet. Example for accrual basis accounting. Let's go back to the same freelance example. You provided service worth rupees 10,000 in May and got paid in June. Under accrual basis, you will record that income in May when you actually earned it. Even if the money isn't in your hand yet, it still reflects your performance and business activity. This method is especially helpful when you give credit to customers or receive goods before paying for them. Cash versus accrual, key difference. In cash basis accounting, cash is recorded when it is received. In accrual basis, it is recorded when it is earned. In cash basis, expenses is recorded when it is paid. In accrual basis, it is recorded when it is incurred. Cash basis accounting is simple, accrual basis accounting is complex. Cash basis accounting is less accurate, accrual basis accounting is more accurate. Cash basis accounting is suitable for small businesses, accrual basis accounting is suitable for growing business. Advantages of cash accounting. Now let's look at the advantages of cash accounting and why so many small businesses prefer it. Simple to maintain. This is major benefit. You don't need complex systems or professional help to get started. You record income when you get paid and expenses when you pay. Great for tracking cash flow. It shows you exactly how much cash is in your business. No confusion with unpaid invoices or future bills. Easier tax filing for small businesses. You only pay tax on the income you actually received. This can help save money in tight months. Helps avoid paying taxes on money not yet received. This is huge relief for small businesses. You don't pay tax on promises. You pay only on actual receipts. Cash accounting is ideal for businesses that deal mostly in cash or don't have inventory. Disadvantages of cash accounting. But cash accounting also comes with some drawbacks you should be aware of. May not show full picture. You might have made a lot of sales, but if the money hasn't come in, it won't show in your records. Misleading for long term. Because it focuses only on cash, it doesn't show what you have earned or owe. It can give a false sense of profit or loss. Not accepted for larger businesses. As your business grows, or if you need to present financials to investors, bankers, or government, cash accounting may not be allowed. So while it's easy, it's not always ideal for every stage of business. Advantages of accrual accounting. Now let's talk about the accrual method, a bit more complex but powerful in understanding true business performance. Gives a clearer picture of business performance. You see income when you earn it and expenses when they happen, giving you an accurate view of profitability. Matches income and expenses accurately. If you spend money to earn income, both are recorded in the same time period. This shows true margins and financial health required by law for many companies. If you operate in multiple countries, deal with inventory, or cross certain income threshold, this method may be mandatory. Powerful in forecasting. Because it includes unpaid invoices and upcoming bills, you can plan future cash needs and growth better. For businesses with more volume or complexity, accrual gives a long-term view. Disadvantages of accrual accounting. Of course, no method is perfect, so here are the challenges with accrual accounting. Complex setup. You will need to understand concepts like accounts receivable, payable, cost of goods sold, and more. It's not always DIY friendly. Requires good tracking. You have to stay on top of invoices, bills, and due dates. Missing entries can affect your financial reports. May pay taxes on unpaid income. This is the tricky part. If you record income before receiving it, you might have to pay tax before getting the actual cash. This can create a cash crunch if not planned properly. That's why having a professional bookkeeper can help avoid surprises. Which method should you use? Here's the big question, cash or accrual, what's best for you? If you're a small, service-based business dealing mostly in cash or online payments, cash basis is perfect. If you sell inventory, deal with credit, or want accurate profits, accrual basis is better. If the law requires based on turnover or reporting standards, you must use accrual accounting. So now you know the difference between cash and accrual accounting, how each one works, their advantages and limitations, and which type of business they suit best. If you're small, service-based business, cash accounting is simple and efficient. If your business deals with inventory, offers credit, or plans to grow, the accrual accounting gives a clearer, more complete financial picture. So we will learn how to record journal entries using simple and practical examples, perfect for beginners. Journal entries in accounting. What is a journal in accounting? A journal is a book of original entry where transactions are recorded in the chronological order as and when they take place. This means a journal entry is the first record of a transaction in accounting. It captures the date, amount, accounts involved, and whether they are debited or credited. Think of a journal as a diary for your business. Every time money comes in or goes out, you write it down with full details. Let's see the journal entry format. Date, particulars, ledger, folio, debit and credit. You record the date of the transaction and the accounts debited and the account credited, and then the narration. Let's now use the simple example and understand. Example, journalize the following transactions in the books of Mr. Ram. April 1st, business commenced with a capital of rupees 10 lakh. April 3rd, deposited in the bank account rupees 5 lakh. April 5th, purchased plant and machinery costing rupees 2,30,000 by paying 30,000 cash. April 7th, purchased goods worth rupees 40,000 for cash. April 9th, paid a check of rupees 2 lakh to the supplier for plant and machinery. You can see that on April 5th, we purchased plant and machinery costing rupees 2,30,000 and we paid only 30,000 in cash. And the remaining 2 lakh is paid on April 9th. April 11, sold goods for 70,000 rupees. April 15, withdrawn by the proprietor rupees 35,000 cash for personal use. It is a drawing. April 20th, insurance paid by check 2,500. April 22, salary paid 5,500. April 30, furniture of rupees 30,000 purchased in cash. We'll start with the first transaction. That is, business commenced with a capital of rupees 10 lakh. That means the owner is investing into the business. So cash comes in and capital is credited. Here the two accounts are cash account and capital account. Cash is real account, cash comes in the business. So debit what comes in. And the other account is capital account. Capital account is personal account and the proprietor is giver. So credit the giver. So we record it as, this is the format. Journal entries in the books of Mr. Ram. Date, particulars, ledger, folio, debit and credit. And we record it as on 1st April, cash account debit 10 lakh rupees to capital account 10 lakh rupees. And the narration is being capital introduced into the business. Next transaction is April 3rd, deposited in a bank account 5 lakh rupees. Now cash decreases and bank balance increases. So the two accounts are bank account and cash account. Bank account is personal account. Bank receives the cash, so debit the receiver. And cash account, cash is real account. Cash goes out, so credit what goes out. So we record it as April 3rd, bank account debit 5 lakh rupees to cash account 5 lakh rupees being cash deposited into bank. And the next transaction is April 5th, purchase plant and machinery costing rupees 2,30,000 by paying 30,000 in cash. In this transaction, 30,000 is paid now and the rest 2 lakh will be paid later. So we debit the full value of the asset and credit cash for what is paid and credit a payable for the balance. So here 3 accounts are involved. That is, the accounts are plant and machinery account, cash account and machinery supplier account. So plant and machinery, it is real account. Asset comes in the business, so debit what comes in. And cash account, it is real account. Cash goes out. So credit what goes out. And supplier is a personal account. And supplier is creditor. So credit the giver. So the transaction is April 5th, plant and machinery, debit account, 2,30,000. It is the whole amount. And next we paid cash. To cash, only 30,000. And the rest will be paying on credit basis to machinery supplier account, that is 2 lakh. And the narration is being machinery purchased partly in cash and partly on credit. That is 2 lakh we have to pay to the supplier. And the next transaction is purchased goods worth rupees 40,000 for cash. Here the two accounts are purchase account and cash account. Purchase account is a nominal account, expenses incurred, so debit all expenses. And cash account, cash is real account, cash goes out. Credit what goes out. So we record it as April 7, purchase account debit 40,000 to cash account 40,000, being goods purchased for cash. And the next transaction is April 9, paid a check of rupees 2 lakh to the supplier for plant and machinery. This is the same transaction from 5th April. That is, now we are paying 2 lakh rupees. And here the two accounts are supplier's account and bank account. Supplier's account. Supplier is a personal account and liability reduces. So debit the receiver. And bank account. Bank is a personal account. Bank balance goes down. So credit the giver. So we record it as April 9, machinery supplier account debit 2 lakh rupees to bank account 2 lakh rupees, being payment made to supplier by check. And the next transaction is April 11, sold goods for rupees 70,000. Here the two accounts are cash account and sales account. Cash is a real account and cash comes in the business. So debit what comes in. And sales is a nominal account and it is income earned. So credit all incomes. So we record it as April 11, cash account debit 70,000 to sales account 70,000, being goods sold for cash. And the next transaction is April 15, withdrawn by the proprietor rupees 35,000 cash for personal use. Here the two accounts are drawings account and cash account. Drawings account, it is a personal account and owner is the receiver. So debit the receiver. And cash account, cash is real account, cash goes out of the business. So credit what goes out. So we record it as April 15, drawings account debit 35,000 to cash account 35,000, being cash withdrawn by proprietor. And the next transaction is April 20, insurance paid by check 2,500. Here the two accounts are insurance account and bank account. Bank account because it is paid by check. So insurance account, it is nominal account and it is expenses for the business. So debit all expenses. And we paid by check. So bank account. Bank is a personal account. Bank balance reduces. So credit the giver. So we record it as April 20th, insurance account debit 2,500 to bank account 2,500, being insurance premium paid by check. And the next transaction is April 22, paid salary 5,500. Here the two accounts are salary account and cash account. Salary account, it is nominal account and it is expenses to the business. So debit all expenses. And cash account, cash is a real account, cash goes out of the business. So credit what goes out. So we record it as April 22, salary account debit 5,500 to cash account 5,500, being paid salary. April 30th, furniture of rupees 30,000 purchased in cash. Here the two accounts are furniture account and cash account. Furniture account is real account and furniture is an asset and it comes in the business. So debit what comes in. And cash account. Cash is a real account. Cash goes out of the business. So credit what goes out. So we record it as April 30th, furniture account debit 30,000 to cash account 30,000, being furniture purchased for cash. As you saw, every entry follows a logic. What comes in is equals to debit, what goes out or is owned is credited. We are covering an important topic, ledger in accounting. What it is, why it is called the principal book of accounts, its format, types, and then we will prepare the actual ledger step by step so even a complete beginner can understand. So let's get started. What is a ledger? Ledger is known as the principal book of accounts. It is where all financial transactions recorded in the journal are classified, organized, and summarized under individual account heads. It means all transactions are first recorded in journal, but in ledger we sort and summarize them under separate account heads. So you will have a cash account, capital account, rent account, etc. That way you can see all the transactions for each account together, neatly organized. Why is ledger important? It helps to prepare trial balance and final accounts like profit and loss account and balance sheet. It gives you a clear view of all transactions for each account, like how much cash you received, spent, or still have. It ensures that debits and credits are balanced, which keeps your books accurate. Types of ledgers. Broadly, there are three. That is general ledger, main ledger that includes all the accounts such as cash account, capital account, rent account, and then debtors ledger, also called as sales ledger. It records customers account, and creditors ledger or purchase ledger. It records supplier accounts. Example, if the business sold goods to Mr. Ram and Shyam on credit, their details go to debtors ledger because we sold the goods, and for sales we record it in debtors ledger, and if we purchase on credit we record it in creditors ledger. Ledger format. This is a ledger format. It looks like a T account. That is, left side it is called debit side and right side it is called credit side. Each side has date, particulars, that is what the business is about, and journal folio. Like in journal we had ledger folio, here we have journal folio, and amount. Similarly on the credit side, date, particulars, journal folio, and amount. This format helps keep records clear and balanced. Now let's look at the example. Journalize the following transactions in the books of Mr. Shyam. April 1st, business started with capital rupees 10 lakh. April 3rd, deposited rupees 5 lakh into bank. April 4th, bought goods for rupees 2 lakh cash. April 6th, sold goods for rupees 3 lakh cash. April 8th, paid rent rupees 25,000. April 10th, received commission rupees 10,000. Now let's record journal entries step by step and pass the ledger. So first we record it in journal. Our first transaction is business started with capital rupees 10 lakh, and the two accounts affected here are cash account and capital account. Cash account, it is real account and cash comes in the business, so debit what comes in. And next one is capital account. Capital account is personal account and proprietor is the giver, so credit the giver. So we record it as journal entries in the books of Mr. Shyam. That is date, particulars, ledger folio, debit and credit. And on 1st April, cash account debit 10 lakh to capital account 10 lakh. And the narration is being capital introduced into the business. Next on April 3rd, deposited 5 lakh rupees into bank. Here the two accounts are bank account and cash account. Bank account, it is personal account and bank receives cash, so debit the receiver. And cash is a real account, cash goes out, so credit what goes out. And we record it as April 3rd, bank account debit 5 lakh to cash account 5 lakh, being cash deposited into bank. April 4th, bought goods for rupees 2 lakh cash. Here the two accounts are purchase account and cash account. Purchase account, it is nominal account and expenses incurred, so debit all expenses. And cash account, it is real account, cash goes out of the business, so credit what goes out. So we record it as April 4, purchases debit 2 lakh rupees to cash account 2 lakh, being bought goods for cash. April 6, sold goods for 3 lakh rupees cash. Here the two accounts are cash account and sales account. Cash account, it is real account and cash comes in the business, so debit what comes in. And sales is a nominal account and income earned, so credit all incomes. And we record it as April 6th, cash account debit 3 lakh rupees to sales account 3 lakh rupees, and the narration is being sold goods for cash. April 8th, paid rent 25,000. Here the two accounts are rent account and cash account. Rent account, it is nominal account, expenses, and debit all expenses and losses. And cash is a real account, cash goes out of the business, so credit what goes out. And we record it as April 8, rent account debit 25,000 to cash account 25,000, and the narration is being paid rent. Next, April 10th, received commission 10,000 rupees. Here the two accounts are cash account and commission received. Cash account, it is real account and cash comes in the business. So debit what comes in. And commission is a nominal account and it is income. So credit all incomes and gains. So we record it as April 11 cash account debit 10,000 to commission received 10,000 and the narration is being received commission. Now we have recorded all the journal entries. Now we will pass the ledger for each account. Now let's look at the journal entries and pass the ledger. That is on 1st April we have cash account debit 10 lakh rupees to capital account 10 lakh rupees. So if we create a cash account ledger, we record corresponding entry as to capital account on the debit side of cash, and for capital account we record on credit side by cash account. So we will see how we record it. On 1st April cash account debit 10 lakh rupees. We go to cash account ledger. This is the format: cash account debit side and credit side. Date particulars, journal folio, amount, date particulars, journal folio and amount. And we record it as, on 1st April, we record it as 2 capital and 10 lakh rupees. Similarly, in capital account, we record it as by cash. Let's see how we'll record it. This is capital account. On 1st April, we record it as by cash. This is double entry system. In cash account, we recorded capital on the debit side, but in capital account, we recorded cash on the credit side. Similarly, we'll record other transactions. On April 3rd, bank account debit 5 lakh to cash account 5 lakh. That is, now we'll record on the bank account ledger and cash account ledger. That is, we'll record in the bank account debit side to cash and in the cash account by bank account. Let's see how we'll record it. This is bank account. On the debit side, we record April 3rd to cash 5 lakh rupees. Similarly, in the cash account, we will record it as cash account. Remember, we had recorded on 1st April capital 10 lakh rupees. Now we will record on the credit side, that is April 3rd by bank 5 lakh rupees. And see the format: debit side we recorded 2 and on the credit side we record by. Now let's see the next transaction. April 4th, purchase account debit 2 lakh rupees to cash account 2 lakh rupees, and we record it as in purchase account debit side to cash and cash account credit side by purchases 2 lakh rupees. Let's see how we'll record it. Purchase account debit side April 4th to cash account 2 lakh rupees, and the next account is cash account credit side April 4th by purchase account 2 lakh rupees, and the next transaction is April 6th cash account debit 3 lakh rupees to sales account 3 lakh rupees. We record it in cash account and sales account. Cash account debit side to sales 3 lakh rupees and sales account credit side by cash 3 lakh rupees. So we'll see how we'll record it. Cash account debit side April 6th to sales account 3 lakh rupees, and sales account we'll see it, and sales account credit side April 6th by cash 3 lakh rupees. And the next transaction is April 8 rent account debit 25,000 to cash account 25,000, and the two accounts are rent account to cash account. In the rent account we record debit side to cash 25,000, and in the cash account we record by rent 25,000. Let's see it. Rent account debit side April 8 to cash account 25,000, and next is cash account. Cash account credit side April 8 by rent 25,000. You can see every account has one debit and one credit. Let's see the next transaction. April 11 cash account debit 10,000 to commission received account 10,000. In cash account we record as commission account on the debit side, and in the commission account we record as by cash credit side 10,000. Let's see how we'll record it. Cash account debit side April 10 commission received 10,000. Similarly, in the commission account we record it as commission account credit side April 10 by cash 10,000. Now we have recorded all the transactions from the journal. Now let's close the accounts. This is the cash account and the total is 10 lakh plus 3 lakh plus 10,000. It is 13 lakh 10,000. So here the balance is 5 lakh 85,000 and we record it on end of the month April 30th by balance carried forward, and the next month when we open the account we record it as on 1st May to balance brought down and the amount is 5,85,000, and we record other transactions similarly for the next month. While we post from journal to ledger, we are not just copying, we are organizing data to see the total effect on each account. That is why it's called principal book of accounts. At the end of the period, the balance of carried forward shows us exactly what remains. For example, our cash account shows 5,85,000, so we know how much cash is on hand. Now let's close other accounts. Capital account, there was only one transaction, that is 10 lakh, and in the total 10 lakh and April 30th balance carried forward 10 lakh. And the next account is bank account. We have only one transaction, that is cash account. Total is 5 lakh and the balance carried forward is 5 lakh rupees on 30th April. Next is purchase account. We total it 2 lakh rupees and on 30th April by balance carried forward 2 lakh rupees. Similarly, sales we have 3 lakh rupees and the total is 3 lakh on 30th April by balance carried forward 3 lakh rupees. And the next account is rent account and the total is 25,000 on 30th April by balance carried forward 25,000. Commission received account, total is 10,000 on 30th April by balance carried forward 10,000. Now we have closed all the accounts. In cash account, debit side, you will see where the cash came in. In other accounts like capital account, you will see the corresponding credit. This is the capital account, you can see the corresponding credit. Cash account. Every debit in one account is matching to every credit in another account. This is called double entry system. When all the ledgers are balanced, we list the closing balances in a trial balance. If the total debits equal total credits, it shows our books are arithmetically correct. We will learn what a trial balance is, why it is important, and most importantly, how to prepare a trial balance step by step using a practical example. What is trial balance? A trial balance is a statement that lists all the debit and credit balances of ledger accounts on a specific date. It helps ensure that total debits equal total credits and checks that our books are arithmetically correct. It means trial balance is a summary sheet to check errors before preparing the final accounts like profit and loss account and balance sheet. Why do we prepare trial balance? To confirm books are balanced. It shows at a glance whether total debits are equal to total credits, providing you have applied the double entry system correctly. To detect errors like posting on the wrong side and wrong amounts, etc. Trial balance prevents many common errors. To prepare profit and loss account and balance sheet easily. Once your trial balance matches, you know your ledger balances are ready to be transferred to P&L account and balance sheet. It reduces confusion and last-minute correction. To save time during final accounts. A balanced trial balance avoids rechecking hundreds of entries later. It serves as a working paper for accountants and auditors. Now let's move on. Format of trial balance. Particulars, ledger folio, debit and credit. You list every account's closing balances from ledger. Assets and expenses usually shows credit balance. Liabilities, capital and income usually shows credit balance. Now let's look at the example. Let's say we have these ledger balances at the end of April. These are the same balances we got in the ledger account from our previous video. That is cash account 5,85,000 on debit balance, bank account 5 lakh debit balance, purchases account 2 lakh debit balance, sales account 3 lakh rupees, credit balance Rent account 25,000 debit balance. Commission account 10,000 rupees credit balance. Capital account 10 lakh rupees credit balance. Now let's create the trial balance. First is cash account 5,85,000. We have debit balance. So this is the trial balance format. Sham Limited trial balance as on 30th April 2025. Particulars ledger folio debit and credit. And we have got cash account 5,85,000 debit balance. So we record it as cash account debit side 5,85,000. Next, bank account 5 lakh rupees debit balance. And we'll record it as bank account debit side 5 lakh rupees. Next, purchases account 2 lakh rupees debit balance. So we'll record it as purchase account 2 lakh rupees on the debit side because we had debit balance. Next, sales account 3 lakh rupees credit balance. So we'll record it as sales account 3 lakh rupees on the credit side. Next, rent account 25,000 debit balance. So we record it as rent account 25,000 on the debit side. Next, commission account 10,000 rupees credit balance. So we record it as commission account 10,000 rupees on the credit side. Capital account 10 lakh rupees credit side. So we record it as capital account credit side 10 lakh rupees. Now we have completed recording all the balances. Now total both debit and credit columns. 5,85,000, 5 lakh, 2 lakh, 25,000 is equals to 13 lakh 10,000 on both the sides. If totals match, our books are balanced. If not, there may be an error in ledger posting or balancing. Remember, trial balance doesn't guarantee books are error-free, but it's a vital checkpoint. It's always prepared before the final accounts. Once your trial balance matches, next we will learn how to prepare the profit and loss account and balance sheet. That's where you will see business profit and financial position. We will understand final accounts. That is trading account, profit and loss account, and balance sheet with the help of examples so you can really understand how they work together. What are final accounts? Final accounts are financial statements prepared at the end of accounting year. They help us know the profit or loss made during the period, the financial position of the business. Final accounts are not just mechanical statements, they are the outcome of the whole accounting process. Final accounts transform day-to-day records into useful insights and help us to see how effectively the business traded with the help of trading account, the overall profitability after all indirect expenses and other incomes with the help of profit and loss account, and finally what the business owes and owns at year end with the help of balance sheet. This is why preparing final accounts is one of the most important steps in accounting cycle, both for small businesses and large corporations. Why do we prepare final accounts? To measure gross and net profit or loss, to check the true financial position of the business, to provide clear information for owners, lenders, and other stakeholders. Now, why do we actually prepare final accounts? The obvious answer is to find profit or loss, but there is a deeper reason. Final accounts help business owners evaluate how effectively resources were used, spot trends, and compare with past years. They also reassure lenders, investors, and tax authorities by showing transparent financial results. Most importantly, they provide a factual basis for making key decisions such as should we expand, should we control certain costs, how healthy is our cash position. So, the real value of final accounts is turning scattered data into actionable insights for better business decisions. Structure and flow. First, we prepare trading account, then profit and loss account, and lastly, balance sheet. This is the format of trading account. Trading account for the year ended. So and so. Debit side and credit side. Debit side, particulars amount, and on the credit side, particulars and amount. First, we record opening stock, then purchases, and from purchase, we deduct purchase return and all the direct expenses such as carriage inward, freight, octroi, wages. And on the credit side, we record sales, And from sales we deduct sales return and then closing stock. Then we calculate the totals on both the side. If the credit side is more than the debit side, then it is gross profit. We record it as gross profit carried forward. And if the debit side is more than the credit side, we record on the credit side by gross loss. One thing to remember here is we record only direct expenses and direct incomes in trading account. Okay. Now let's see the format of profit and loss account. Profit and loss account for the year ended so and so, debit side and credit side. Particulars amount on the debit side, and on the credit side particulars and amount. To gross loss brought forward. If it is loss, remember we took gross profit and gross loss in trading account. The remaining balance will be brought forward to profit and loss account. That is to gross loss brought forward if it is loss, and on the credit side by gross profit brought forward if it is profit. We take the same balances in the profit and loss account. Then on the debit side we record all the indirect expenses such as salaries, insurance, rent, office expenses, depreciation, bad debts, discount allowed, advertisement. And on the credit side we record all the indirect incomes by commission received, by interest received, by discount received, and other incomes. Similarly calculate the total we calculate the total for both the sides, debit and credit side. If the credit side is more than the debit side, then it is net profit. And if the debit side is more than the credit side, it is net loss. In the trading account, we record direct expenses, but in profit and loss account, we record indirect expenses and indirect incomes. Now let's see the format of balance sheet. Balance sheet of Mr. ABC as at date, month and year. Liabilities amount, assets and amount. On the liability side, capital, add net profit that we got from profit and loss account. Remember lastly we got net profit or net loss. If it is net profit we'll add it, and if it is net loss we'll deduct it. Less drawings made by the owner. And then sundry creditors, bills payable, bank loan, long-term loan. And then outstanding expenses such as outstanding wages, outstanding rent, outstanding salaries, any outstanding expenses we have to pay, we'll record it here. And on the asset side, we'll record all the fixed assets such as machinery, furniture, fixtures, and from that we will deduct all the depreciation. Example, if we have recorded machinery, less from the machinery we will deduct depreciation of machinery. And if there is one more asset, furniture, from furniture we will deduct depreciation of furniture. Okay. And then closing stock. Remember in trading account we took on the credit side closing stock. Same closing stock will be recording on balance sheet as well. Then sundry debtors, less provision for bad debts. What all the provisions we kept for the bad debts will deduct it from debtors. Cash in hand, cash at bank, prepaid expenses and accrued incomes. And lastly, when we will calculate the totals, debit side and credit side, that is assets and liabilities, both we should tally. Now let's look at the example. Prepare the trading account, profit and loss account and balance sheet for Mr. Ram as on 31st March based on the following balances. Particulars amount: machinery 27,000, sundry debtors 21,600, drawings 2,700, purchases 58,500, wages 15,000, sundry expenses 600, rent and taxes 1,350, carriage inward 450, bank, that is amount in the bank 4,500, opening stock 6,000, capital 60,000, bills payable 2,800, sundry creditors 1,400, sales 73,500 and closing stock 22,500. Now let's record one by one. Machinery 27,000. Remember we record machinery in balance sheet, that is asset side. Let's see how we'll record it. This is the format of balance sheet, that is balance sheet of Mr. Ram as at 31st March 2025. Liabilities amount, assets amount, and we record it as machinery 27,000 on the asset side because machinery is an asset. Next, sundry debtors 21,600. Sundry debtors we record it in balance sheet, that is 21,600. Let's see how we'll record it. Sundry debtors 21,600 asset side. Next, drawings 2,700. Drawings, remember we recorded in balance sheet, that is liability side. It is drawings of the owner. Let's see how we'll record it. Balance sheet liability side less. Remember from capital we deduct drawings 2,700. Purchases 58,500. Purchases we recorded in trading account. That is purchase is an expense. 58,500 we recorded on debit side. Let's see how we'll record it. This is the format of trading account. Trading account of Mr. Ram for the year ended 31st March 2025. Debit side and credit side. Particulars amount. And on the debit side we record two purchases 58,500. Remember we have to record opening stock. So we left the place for that. And next we have recorded two purchases 58,500 on the debit side because it is an expense. Next, wages 15,000. Wages is direct expenses, so we record it on trading account, that is debit side. Let's see how we'll record it. Trading account debit side two wages 15,000 because it is direct expenses, and direct expenses we record in trading account. Next, sundry expenses 600. Sundry expenses is indirect expenses, so we record it in profit and loss account. That is, it is an expense, so it is on the debit side in profit and loss account. Let's see how we'll record it. This is the format of profit and loss account, that is profit and loss account for the year ended 31st March 2025. Debit side and credit side. Particulars amount. And we record sundry expenses on the debit side because it is indirect expenses. 600. Next, rent and taxes 1,350. Rent and taxes, it is indirect expenses, and all the indirect expenses we record in profit and loss account. That is on the debit side rent and taxes 1,350. Let's see how we'll record it. Profit and loss account debit side rent and taxes 1,350 because rent and taxes it is indirect expenses, and all the indirect expenses we record in profit and loss account. Let's see next. Carriage inward 450. Carriage inward it is direct expenses, so we record all the direct expenses in trading account on the debit side. So let's see how we'll record it. Trading account on the debit side we record, that is carriage inward direct income, so on the debit side. Next, bank 4,500. Bank, it is cash in bank, that is we record it in balance sheet. Remember on the asset side we record bank, cash in hand and cash at bank, so we record it in balance sheet 4,500. Let's see how we'll record it. Balance sheet on the asset side we record bank, that is 4,500. Cash also we record on the same side, that is assets only. Let's see next one. Opening stock 6,000. Opening stock, remember we record it in trading account, that is first entry is opening stock on the debit side. So opening stock 6,000. Let's see how we'll record it. Trading account on the debit side first entry is to opening stock 6,000. Capital 60,000. Capital we record it in balance sheet. From the capital we deduct net profit and drawings, remember, so we record it in balance sheet on the liability side. Let's see how we'll record it. Balance sheet liability side capital 60,000, and from the capital we deduct drawings and we add net profit, and if it is net loss then we deduct net loss. Next, bills payable 2,800. Bills payable, we record it in balance sheet on the liability side. Let's see how we'll record it. Balance sheet, liability side, 2,800. Next, sundry creditors, 1,400. Sundry creditors, we record it in balance sheet on the liability side because we need to pay to the vendors. Let's see how we'll record it. Balance sheet, liability side, sundry creditors, 1,400. Next, sales, 73,500. Sales, we record it in trading account on the credit side because it is income. Trading account credit side, buy sales 73,500 because it is direct income. Next, closing stock 22,400. Closing stock we record in trading account as well as in balance sheet. Let's see how we'll record it. Trading account credit side, buy closing stock 22,400. And the next entry is in balance sheet on the asset side. Let's see how we'll record it. Balance sheet on the asset side, closing stock 22,400. Next, we have recorded all the entries. Now let's close the accounts. This is trading account. Let's calculate the total. 73,500 plus 22,400. 95,900. And from 95,900 we deduct debit side 6,000, 58,500, 15,450, and the balance is 15,950 to gross profit carried forward. If we would get gross loss, we would record it on credit side by gross loss. But here we got gross profit, so we record it on debit side to gross profit carried forward 15,950. And this gross profit carried forward, we record it in profit and loss account credit side by gross profit brought forward 15,950. Let's see how we'll record it. This is profit and loss account, and we will record gross profit brought forward on the credit side by gross profit brought forward 15,950. Now let's close the accounts. 15,950 and the balance is 14,000 on the debit side to net profit carried forward, and the net profit we will record it in balance sheet 14,000. Let's see the balance sheet. This is the balance sheet. Let's record the net profit. Liability side, add net profit 14,000. 60,000 plus 14,000 minus 2,700. 71,300. Now let's close the account. 71,300 plus 2,800 plus 1,400. 75,500 on both the sides. Now our balance sheet is tallied, which means all the entries are correctly posted and the accounting equation is satisfied. All the direct incomes and expenses are recorded in trading account, and all the indirect incomes and expenses are recorded in profit and loss account. That net profit has been added to capital in the balance sheet. And finally, assets is equals to liabilities. So our books are balanced. Thank you for watching. I hope you found it helpful in building a strong foundation in accounting. If you liked this video, don't forget to like, share and subscribe to the channel for more step-by-step lessons. And if you have any doubts, feel free to drop them in the comments. I'll be happy to help you out. See you in the next video.